Aloha, this is Joshua Hayes with your September 15th market wrap. Let's get straight into the charts here today as we had what I would call a significant crash today. But you know what? The death cross came in 2008 after the top that I clearly told you about in October, that we clearly discussed back then in October. How charts were giving me poor charting signals, all the stocks that were breaking out in 2007 that were failing. It was just obvious that something was wrong. When we broke down, we knew it was time to go lower. When we had the death cross in 2008, that then told us that we knew not to go long stocks at all in the indexes. And price stayed below the 50-day moving average like they always do. Well, initially during a death cross for the index. As it breaks above the 50-day moving average, it now finds the 200-day moving average impossible to break out through, and soon it's breaking down again below the 50-day moving average in May. And as we go along, we can see prices can never get above the 50-day moving average. And until prices can get above the 50 and 200-day moving average, you know not to go long. So, by using just the death cross as your signal, the entire 2008 17% loss in the Dow Jones Industrial Average could have been avoided by simply not buying stocks while the indexes were in a downtrend. You can see on today's breakdown on the Dow Jones Industrial Average, volume surged to its highest level since March. This was a major breakdown at a key resistance area and is very ugly for the big caps that are known to hold up the best in the bear markets. So let's look at the New York Stock Exchange now, and you can see we've got the same thing. We've got a death cross in January after a top in October 31st. It got above the 50-day moving average in April, tried to break out in May, but very soon it did it on low volume. That's low volume, below the 50-day volume average. It was soon back below, squeezing in between the 250 and soon breaking down below the 50-day moving average. And now it's breaking down on heavy volume, as you can see, 5%. Oh my God, I had no clue that it went down 5% today. So the New York Stock Exchange fell 5% today, and since its 2008 beginning to now, it is now down 21%. So if you're doing better than 21%, you're beating the market. Negative 21%. Just remember that. Let's look at the S&P 500 for the last big cap index, and we see the same thing. This time, though, the death cross happened in December, and it happened earlier. And as you can see, price stays below the 50-day moving average, gets up to the 200-day moving average, and the only time it does, it fails with a tail. It can't even close above it, and it goes right back below it, staying in a downtrend, soon breaking down below the 50-day moving average and staying below the 50-day moving average, messing around the 50-day moving average here, and now a huge drop on the S&P 500, 4.71% today on much higher volume than the day before. Like if this was set up with price above the 50-day moving, above the 200-day moving average, and you got this move on green volume instead of red, that would be a follow-through day. This is a follow-through day to the other direction. This is a follow-through day to the downside. Now, let's look at the NASDAQ, which is the index that I operate off the most. As you can see, it death crossed in January as it went up a little bit more in October than the rest of it did. Since the October top till now, the NASDAQ has lost 23%. So, it's been a rough and nasty ride. This index today was only down 3.6% though. So there gave some comfort to the fact that, hey, the markets aren't all that bad. But the NASDAQ doesn't hold the banks. It's still down 17%. But the good news is that maybe in time, a year, 2 years, 6 months, 3 months, I don't know. Nobody can predict the future. All those people on CNBC are full of crap. And I still can't believe that subscribers to this website watch CNBC. Stop watching CNBC and getting those opinions mixed in with your charts. This is all that you needed to know to save your butt in the stock market, was that the 50-day moving average and 200-day moving averages are your lines in the sand. And then, of course, there's the S&P 600. As you can see, it is breaking down on 3.76% below the 50 and 200-day moving average, with the 50-day moving average staying below the 200-day moving average. This is one index that has ignored the death cross and tried to break out above it a couple of times, but as you can see both times it's massively failed. And now, though, as you see the S&P 600 breaking down on 3.76%, notice its relative strength line. Notice down here the white line going to a new high, once again showing that the S&P 600, while it goes down this year and is down around 7%, that, as you can see, compared to 20%, 7% ain't much. That's why this relative strength line, this white line, is flying upwards, which means when this market bottoms, I'm sure that the S&P 600 stocks will lead. But they've been, in a decline since the top, and after a very long uptrend, it's now, time for a downtrend. These stocks were going up from the 2002 lows all the way to the 2007 highs. Where were you all? Where's everybody? Why did everybody come into the market just last year? I have no clue why you guys did it. I have no clue why you guys weren't in the market in 2003 and 2004. But if you weren't, you really paid for it, because that's when all the big money came. But now every index is once again below the 50-day moving average, with the 50-day moving average below the 200-day moving average. Simply, this is a market I wouldn't touch with your money for free. I wouldn't gamble with it. Look at that New York Stock Exchange chart, down 5% today. This is a market you want to avoid, and this is part one of my market wrap-up. I will go into part two and part three very shortly, which is the longs and shorts. I hope you enjoyed my presentation, and I hope that this easy lesson on following price, 50 and 200-day moving average will teach you to stay out of the market when the price is not above the 50-day moving average and the 50-day moving average is not above the 200-day moving average. I mean, look at 2005 when it was going up even. It found support at the 200-day moving average while the 50-day moving average traveled above it. And then we can go back and look at 2003. Look at 2003, perfect. Look at 2004. Even whenever it got close, it death crossed a little bit, and then it recrossed, and it was back in an uptrend with green bop and heavy, huge volume whenever it broke out. I mean, there was just no doubt about that. It's a bullish chart whenever it's trending above the 50 and 200-day moving average. I mean, that's whenever you're supposed to be long. Right now, there is no way any of you should be long anything. I can go long certain stocks because I know how to beat the market, find some stocks like XSI, which probably got destroyed today for all I know. I mean, I don't know. But the bottom line is that the markets look ugly, and I'm going to wrap it up there. Part 2, and Part 3 are coming up shortly. Thank you very much. This is Joshua Hayes at BigWaveTrading.com.